Hi everyone, I'm Penny. My name's Penny Hicks. I'm from Manchester Counterfire and I'm chairing this afternoon's meeting on wages, prices and profit. And I don't know if you've been like me, but every time you hear, reports on the strikes on the radio or see them on the news, I'm screaming at the radio, no, wages don't cause inflation. They're not the only, so I'm hoping that the session this afternoon will arm us with those arguments about what part wages, prices and profits do play and the cost of living crisis, so that we feel confident in having those arguments and those discussions on the picket lines and everything that's happening. We've got two amazing speakers. In fact, Michael Roberts said, don't read out all my books because it'll take out a minute of his time. So I won't, but he's written loads, right? Absolutely loads. But his blog, which is called thenextrecession.wordpress.com, I would say, if you're going to go anywhere to read Michael's stuff, that would be an excellent place. And Susan Newman, who's an academic, an activist, and is currently head of economics at the Open University. So fair play, yeah. So right, we're not at school, we have got slides, but we're all going to wade in and try and understand this subject and ask our questions. So yeah, Michael, would you like to get the discussion started?
Yes, well, thank you very much, Penny, and everybody for inviting me to speak on this very important and very topical subject, the question of what's causing inflation and how, as you say, this question has to be answered by those who are struggling to maintain their incomes in the face of massive inflation increases and the attacks of the media on any sector of the trade union and labour movement which seeks to raise wages in order to compensate for price rises, with the accusation that you're just going to make the situation worse, which is what Mick Lynch and others are being facing with at the moment. In order to help us understand what's the nature of inflation at the moment and what's happening, I'm only going to show you a few slides, as I usually do. And so I'm just going to try and share those with you. So, okay, causes and consequences. Me. So there's the current situation on inflation in the UK. We're at a 40-year high. That means the inflation rate, the increase in prices, is a 40-year high. It's just been announced for the month of May, reached 9.1% over this time last year. And even the Bank of England saying it's going to go into double digits and possibly reach 11% year on year. That's an increase in the average prices that people are paying in the shops or for their energy at home and utilities, an average increase of something like 10 or 11% by the time we get through this summer. And when we look at some of the increases, particularly in areas which affect working people and the poorer sections of society, food and energy prices are rocketing hugely. Road fuel prices up 33%. If you include your mortgage costs, assuming you have a mortgage, then the retail price index is actually up nearly 14% at the moment. That's the size of the increase. And here's the fuel prices. Now, well, not everybody has a vehicle that they have to drive, but many people do, particularly in the areas outside the urban areas. And we've seen a massive increase in road fuel prices taking place in over the last few months. We've seen that, but particularly since the beginning of COVID. And also the energy bills in the UK. We know that they've supposedly regulated these energy companies making huge profits are supposed to have their prices regulated by a so-called price cap. That price cap has been allowed to increase by equivalent of 54% in April 2022. That's £700, the average increase for consumption by people for their energy, gas, electricity. And it's expected another 30 to 50% could be added to the price the maximum price that the energy companies can charge in October. And you can see in the right-hand scale here, this is what it means. See that energy prices have been gradually rising over the years, little by little, you might say, but you can see what the situation is at the moment in summer 2022. That's the shocking crisis which exists, the cost of living crisis as we're calling it. Now, what are the causes of inflation? I just briefly want to give you the mainstream explanations of what causes inflation. The first one is that inflation, according to Milton Friedman, extreme right-wing economist of the 1960s and 70s who said that what causes inflation is that central banks print too much money. They create too much money in the economy compared to what the economy is producing in output. And so if money exceeds in growth, the growth in output, then inevitably this will be reflected in an increase in prices because it can't be reflected in an increase in output. So the answer for him to control inflation is that the central bank should stop printing money. They should increase interest rates in order to control inflation. And that is the solution. The economy, the capitalist economy, produces perfectly harmoniously. It's being interfered with by, on the one hand, central banks by not controlling the money supply, but on the other hand, Friedman also agrees by monopolies, particularly trade union monopolies, that can try to control wage increases and monopolize the labor market. And of course, that argument also is the other main argument against for inflation, which many of the mainstream economists put forward. But is Friedman right? Here's a measure of money supply. That's the blue line, the annual growth in money supply. And here is a measure of the annual growth in inflation. This is for the US, but it applies to other countries. You see the massive increase in money supply that took place, particularly in the last couple of years under COVID, but also it was always above the growth in inflation throughout this period. But money supply did not lead, to begin with, to any sharp increase in inflation whatsoever. And in fact, the whole history of the last 50 years is to show that money supply can rise faster and doesn't lead to a rise in inflation. Why? Because most of that money has not gone into spending on goods and services, but has gone on to speculation in financial markets, in the stock market and the bond market. And so the monetarist theory just does not hold water, both theoretically, as I'll hope to explain briefly in a minute, but also empirically. So what about the other mainstream argument? It is wage rises that cause inflation. And have we heard a lot about this in the last period? The governor of the Bank of England recently said, I'm not saying nobody gets a pay rise, don't get me wrong, but what I'm saying is we do need to see restraint in pay bargaining, otherwise it will get out of control. So he's saying that no restraint in pay bargaining, in other words, no pay increases of any great proportion to cover inflation should take place, otherwise inflation will just get worse. Here is Jason Furman, a leading mainstream economist, just said this week, when wages go up, that leads to prices going up. If airline fuel or fuel ingredients go up in price, then airlines and restaurants raise their prices. Similarly, if wages or flight attendants and servers go up, and that's a big issue at the moment in BA workers, then they also raise prices. This follows from basic common sense, says Jason Furman. Is that really true? Is it true that when workers fight for higher wages, it leads automatically to inflation? This is what I'm going to deal with briefly. And take Jay Powell, he's the head of the Federal Reserve. He says, in principle, by moderating demand, we could get wages down, and then we get inflation down without having to slow the economy. So that's the path. First, get wages down by squeezing people's, raising the cost of borrowing, as he would do to moderate their spending, and therefore we control inflation that way. And leading FT columnists only said recently, what central banks have to do is prevent a wage price spiral that would destabilize inflation expectations. Monetary policy must be tight enough to achieve this. In other words, it must create some slack in the labor market. So he's advocating an increase in interest rates sufficiently to cause unemployment and weaken wage bargaining power, and so stop inflation by stopping wages rising. But is this argument right? Let us remind ourselves, and we weren't there, but back in 1865, a similar argument was presented by John Weston, who was in the Carpenters Union and a general council member on the First International, and he argued that wage rises would only lead to bosses raising prices. So inflation would only put wages back where they were in real terms, and therefore it was a waste of time workers arguing and fighting for wage increases because they would merely lose it in real terms when prices rose. Well, Marx replied to this, and I think he presented some very clear arguments on what was wrong with this argument. First, a struggle for rising wages follows only in the track of previous changes in prices. On the whole, workers only look to raise wages when they see prices rising and they see that their real incomes are declining. So the idea that prices are being driven by a continual militant drive for wage increases by workers is nonsense, said Marx. Secondly, many other things affect price changes or inflation, not just wages to consider. What about the amount of production? Is there enough production being produced? Is the productivity of the workforce strong enough in order to increase output so that it can cover both the demands that people have through their wages and the capitalists investing? And what about the value of money, which we just talked about before? What happens if the capitalists are expanding the money supply, the bankers too much, or the government is devaluing the currency so it's not worth so much in terms of imports? There's all these fluctuations in market prices, said Marx, don't apply to wages as such, but they do apply to different phases of the industrial cycle, whether there's a boom or a slump. So a slump, prices tend to fall away. So do wages. When there's a high boom, then prices can be rising as well. So he would say that that's just not fair, not correct to look at wages alone. And in fact, he says most generally what happens is when there is a rise in wages, what it does is squeeze profits, because that's the other factor missing from this equation altogether. What about profits? If you look at the price of any commodity, it's made up of what it costs to get the raw materials and the depreciation on machinery, what you pay the workers in wages, and what profits are made by the capitalists and the owners of capital when they sell that good. There are three components to prices. Why do the media look only at wages and not at profits? And that was, again, the point that Marx made 160 years ago. And so let's look briefly at the situation now. Here is profits and wages since COVID. This is the figures produced very well by the Unite Union in a new report. They say quarterly GDP, leaving out inflation, has grown by just over 1.6% in 2 years. Pathetic in the case of the UK. Labour income has risen by 1.8%, but profits have risen by over 4% over the same period. And if you have a chance to look at this column, and I'll send these slides around, you can see the changes in real GDP, in labour income and in profits, and you can see the sharp rises that have taken place in profits. And as a recent advisor to many corporations say, in a situation when times are tough, screw your customers, because screwing is good. I don't think it's actually nefarious at all. Companies should do this. Profits is the whole point of the exercise. And to maintain profits is what has to be done. So when wages pressures under there, that threatens profits. We must oppose that to the bitter end. It's not a question, this is a fake argument that wages cause inflation. The argument is really about wages squeeze profits, and that's what capitalists are worried about. But we have a situation now where inflation is outstripping wage rises dramatically. Average wages in the UK are falling at the fastest rate for more than 2 decades, as annual pay growth fails to keep up with the rise in cost of living. And you can see on the right-hand graph here, the red line is the CPI, that's the consumer inflation in the UK, is rising much faster than wage rises are at the moment, as Unite Union pointed out. And in fact, if we exclude, adjust for inflation, annual growth in real regular pay, excluding bonuses for the financial sector, is falling by 4.5% a year, the biggest fall since records began. And even worse than that, if we take the whole period since the end of the Great Recession in 2008-9, real wages have fallen dramatically for the longest period and for the most amount for 200 years, since the end of the Napoleonic Wars. That's how bad the situation is for workers at the moment. It will leave the average worker by the end of 2026 at the current rate of inflation and growth in wages, £13,000 a year worse off than they would have been if they'd maintained the same level of growth even before 2008 in wages, and inflation had been at that level. So in 2026, the average household earnings for a British home will be around 31,000 compared to 43,000 if wages have risen at the same pace as the 2 decades before the banking crisis. So
Michael, I regret to say you've only got a minute or two left.
And I'm nearly there. this will mean an unprecedented hit to earnings in this situation. So this is a disastrous cost of living situation, and it's no fault of the working class and the labour movement at all. I finished on this slide that this leads to two dangers coming up ahead of us, which I want to point out. There's a slump is heading towards it. It could be stagflation and other means of no growth, but still having inflation, or even worse, we have a slump, a collapsing growth in employment and incomes. The two scissors to this slump, blades to this scissor, are the falling profits, which will happen if wages rise, and they're beginning to fall off anyway. And if debt increases to the point where cost of borrowing is so great that lots of companies start to collapse in a corporate debt meltdown. That's the real danger over the next couple of years. Not only do we have inflation out of control, but we're entering a period when we could have a major slump. It's forecast that the UK economy will not grow at all for the next 2 years. That's the situation we face in the UK, and that's what the labour movement faces at the moment. And we shouldn't accept the argument that workers fighting for better wages with this high level of inflation are going to cause worse inflation. The evidence is against it, the theory is against it.
Thank you, Michael. The slides are really excellent and clear, so I'm hoping there is somewhere we can refer back to them. And if you've got any questions,
I'll put them in the chat, Penny.
Thank you. And you can put your questions in the chat or raise your hand when we come to the discussion. Susan, would you like to build on that introduction? I know you've got some slides for us as well.
I also have some slides, yes. No, thank you, Penny, for that. And thanks so much, Michael, for that really comprehensive discussion and the sort of detail in the data as well. I'm hoping to fill in on a couple of aspects of what Michael has shared. Let me just try and see if I can share my screen. Yeah, so I just want to fill in a little bit, really, some of those aspects and sort of go back in time, really, about how the structure of the global economy has changed and how that really underpins some of what's happening today. I mean, what we've been hearing in the news particularly is in discussion of what's causing these price rises, in addition to wages, has been issues of supply chain disruptions that came about with COVID and growing demand, rising oil and gas prices. And, you know, for all of these reasons are correct. They are all contributing to this increase in prices. But I just wanted to point out that prices are only one side of this cost of living crisis. And one of the major aspects of this has been 40 years of wage stagnation. Excuse the typo there. And we've had, and that's very much connected to the issue of growing financial speculation as well, which has been driving commodity price movements over the last 20 years, and particularly since 2008. So what I want to try and say something about how these two phenomena are really rooted in the same problem of capitalist restructuring over the last 30 years, 40, 30 years or so. So I've seen this particular graph kicking around. I've shown versions of this chart at various counterfire meetings and to my students over the last 10 years or so, but I've taken this one off John Rees's Facebook feed. And I think a couple of people have said, this is everything you need to know about capitalism today. And I think I would, argue that's correct. I think we can draw a lot from this particular slide, which is showing us these two periods here called the Great Prosperity in the post-war period until 79 and the Great Regression from 1980 until now. And what we see here is productivity rising on the top line, but compensation to employees' wages has been stagnating, falling, and more recently falling again. Now, this is for the US, but I have similar figures for the UK and most of the global north as well, so across Europe. So this kind of departure between productivity increases and wages, and what that shows us is a big distributional change, right? The slice of the pie between wages and profit that Michael's talked about is going much more towards profit than wage. And that's also led to a greater kind of inequalities in society as well, and particularly around the role of finance for the accumulation of wealth and income, right? So this is really kind of what I wanted to discuss. So one of the reasons for this, questions for this is why haven't wages gone up earlier? And hence why haven't prices gone up earlier? And one of the big answers to that is the change in the globalization of production. So-called global value chains, right? So here is a chart, I hope you can see that, which is from the World Development Report 2020 that looks at global value chains. So this fragmentation of production, you know, slicing up the production process and placing it across different parts of the world, and then trading in intermediate goods. And this has been done largely based around cost saving. So multinational firms are looking to cut, in particular, labor costs and going out to low wage economies to source, you know, cheap labor basically to produce things through processes of super exploitation. And what we've seen this mass in the rise, particularly since the 80s, and there's been some retreat, but it's still a very, very significant share of global trade today. And what I would argue, and I think other Marxists have argued, is that global value chains provide this sort of institutional architecture for super exploitation and unequal exchange between them. So what they're doing is impoverishing workers in the global south further, but at the same time, providing cheap goods that allow for the pressing down of wages in the global north, in the UK as well. So part of the story really is, you know, why hasn't these prices increased? Well, because we're depending on produce from overseas that's from low wage economies. So that's one part of the story. The other part of the story as well, I want to say, is that, you know, even the way in which prices of commodities, foods, oil, all of these things have moved is really diverging from what neoclassical economics tells us. So neoclassical economics tells us that prices reflect supply and demand realities. But what we've seen particularly in the last 30 years, but particularly since 2008, and this is what my PhD research was about over a decade ago, is increasing financial speculation as the main drivers for commodity price movements. And we can see this, so the blue line here is the food price index. If we have this for oil, it's a lot more dramatic. And the red line is the production index, so the supply, as it were. And we can see the supply has been growing at a relatively, kind of steady rate, but food prices have been wildly swinging around these. And in the current period, we can see that again, right? So the question really is why, you know, why do we have these huge hikes in prices when production is moving at quite a steady rate? And an answer to this is financial speculation. And that's come with the financialization of the global economy in general, and also the search of, you know, this money for higher returns, as Michael mentioned, you know, flowing to the financial markets, but also flowing into commodity markets. Because historically, more recently, commodities have become a really important part of portfolio investment because they're seen as an inflation hedge. The idea is that these primary commodities are the inputs into most other goods. So if there's lots of investment in their financial investment, they can help hedge against inflation. But what that often does is to lead to a self-fulfilling rise in prices. So what we might see here is more financial investors going into commodity markets as an inflation hedge, and in turn increasing those prices of those commodities. A big question also is, why would these financial markets affect the prices of real commodities, right? Why does it matter that these financiers are putting all the money there? Well, because actually the commodity traders, of which are very extremely concentrated, themselves are using these markets as a reference price, and they also benefit from price changes also. So there's much closer sort of ties between these financial markets and commodity prices themselves. So I think we can see that happening increasingly now. But I think also another aspect of this financialization is the way in which all of our lives are tied to these financial markets. So, you know, for example, our pension funds, right? So I just want to show you the next chart, and this is for oil, which is arguably the most financialized commodity, but I'm collecting some data at the moment to just update my data on other commodities, and we see very similar things. So what we see here is open interest. So this is the activity on these commodity exchanges for oil, and the black section are commercial dealers. So these are the traders, these are the oil traders who are looking to hedge against price changes. But the others are swap dealers and managed money. So these are pure financial speculation, we can say. But the managed money part is a really important part of this. And who are the managed money? What is managed money? Well, these are the big asset management firms where much of our pensions, if we have any private pensions or any pensions outside, you know, as the state pensions are are invested. And these are enormous corporations. So I just want to give a few figures on that. So the biggest three asset managers are BlackRock, Vanguard, and State Street. And they manage over 20 trillion in assets and control 80% of the market for so-called exchange traded funds for commodities, right? So this is really quite extraordinary, the extent to which these few asset managers are really controlling the prices of commodities and exacerbating these movements in prices.
Susan, you've got 2 or 3 more minutes.
Oh, perfect. Okay. Yeah, so I was just going to, I'm pretty much there. I just wanted to come back and say, that this speculation, this is really driving a lot of these extraordinarily unprecedented swings in prices, particularly around oil, that whilst there are some underlying supply and demand changes, the sort of price changes we're seeing at the moment are really not commensurate to what we're seeing in terms of supply and demand changes. And even if we factor in the fact that things like global value chains, multiply up the amount of fuel needed in supply, just because there's much more trading across national boundaries, that still doesn't really explain the wild changes and the extent to which these prices are shooting up so fast at the moment. But ultimately, both suppliers of these commodities, many of which for agro-commodities are in the global south, and the consumers, we all lose out. One of the things that's been noted with these commodity price rises is that they're generally not passed on to the producers themselves. But and they're claimed very much within the international trader level. I think the point I really want to make with this is that prices that are increasing in the UK today don't originate necessarily in production in the UK. That this is a global issue, and we need to discuss some questions around the possibilities and limits for price controls, but wage increases. But ultimately, it's really about a much more dramatic and radical change in the way in which things are produced and how international cooperation in supply is organized. And I think this is where we need to really think about not only class solidarity in the UK, but international class solidarity as well, not only in terms of the producer of these goods, but also as consumers. The cost of living crisis in the global south is going to be much, much deadlier, particularly in terms of the, these are often agrarian societies reliant on exports of agricultural commodities, and they're seeing, they're dependent on imports of fertilizers, whose prices are increasing enormously. And ultimately what we see is a choice in these countries to either export food or produce food at home for their populations. We also see growing indebtedness as a result of this as well, of the type we saw in the 70s with the oil crises that sort of led to a very long what they call the decade of lost decade of development in the global south, which saw IMF and World Bank imposed austerity there as well. So I think when thinking about this, we do need to think about these issues in a very global way. So I think I can stop there probably, if that's okay, and answer any questions to elaborate anything further later.
Thank you so much, Susan, because both those presentations were so informative about everybody else sitting and watching and listening, but those slides are really, really helpful.